my people, back again with another lesson, and this lesson is going to be based on candlesticks, so the open, high, low, close, and the open, high, low, close. I think I said that twice. Open, low, high, close of a candlestick in the markets. So what a candlestick is in terms of trading, I'm not talking about the candlesticks where you light up when your house is dark, you run out of electricity. I'm talking about a candlestick on a chart, on a trading chart. It looks like a candlestick, so yeah, basically it's all in the name. Let me just look this. So here we've got the wicks of the candlestick, so that's these two lines here, and then these other two lines here, and then we've got the body of the candlestick, which is just thick part of the candle here. So the green candle, which is an up candle, is called a bullish candlestick, and this forms when price opens here. It moves lower, so it forms the low of the candle, then it goes higher and forms the high of the candle, and it closes above opening price. So what makes the candle green is when price closes above opening price. And then we have the bearish candle, which is the black candlestick, where price opens, it moves higher, then it moves lower to form the low of the candlestick, and then it closes below opening price. So the fact that it's closed below opening price is what makes the candle a bearish candlestick, and that's what makes it black. So it means price is most likely to move lower to the downside. Now that you know what a candlestick looks like and how they print in the market, I'm now going to show you, the 3 candlesticks that I look for in the market and how they print in order for me to get in line with the market or stay out of the market. So the first candlestick print that we're going to look at is called the directional candlestick. So what this simply is, it's just basically a continuation in the market. So it's the open, or for the bullish example, it's the open, low, high, and then close. So what this simply is moving on to the lower time frames to get in line with the candlestick's print. So on the right hand side here, we have a daily candlestick, which is a higher time frame, and to the left we have the lower time frame print, which is inside of this candlestick here. So as you can see here, so this is the hourly time frame. Each candlestick represents 1 hour. So on this candlestick here, we got the midnight open. So the midnight opening price. So price opens, it moves lower, which forms the low of the day. So it forms the low of this daily candlestick. And then we get a huge displacement to the upside to form the high of the day, which forms the high of this daily candlestick. And then we move back into the daily range to get the close of the day. And then we get the close of this daily candlestick. And now onto a bearish example of the directional candlestick. We have, again, on the right hand side, we've got a daily candlestick, which represents a higher time frame. And then we've got on the left hand side the hourly time frame, which represents the lower time frames. Like I said before, each candlestick represents 1 hour. So here, on this candle here, we have the midnight opening price, Eastern Standard Time. We get a move higher to the upside to form the high of the day, where we form the high of this daily candlestick. And then price moves to the downside to form the low of the day, which is the low of this daily candlestick, and then price moves back into the daily range to close the day out and close, and then we get a close of the daily candlestick here. So that's the bearish example of a directional candlestick. So as price is moving lower, what to gain from this is once price forms the high of the day and then we get a move lower, that high is supposed to stay intact, and then with moves higher throughout the day we can get in sell position. So we can get a sell position here, price moves back into here, we can get a sell position here. That's where buy low and sell high comes into place. So price moves higher, sell high, price moves higher, sell at a higher point, and so on and so forth until the end of the day, and then we get the close, and then we move on to the next candlestick. Now onto the examples of a directional candlestick. We're going to start off with a bearish example. So as you can see here, if I go on the hourly time frame, if you look on my previous video, my previous order block video, you would know what an order block is. So price has moved into an hourly order block. Now to form the daily candle, we're going to be looking at the 15-minute time frame for lower time frames instead of the hourly. So each candlestick represents 15 minutes. So we get a move to the upside. So here, this line, this orange line here is midnight opening price. We get a move to the upside, digging deeper into the hourly order block. Then we get a displacement lower. If we carry on, price is printed lower, it's printed lower, and then we get a move back into the daily range with a displacement this big. I expect the high that was formed. So when price opened on midnight and it got a move higher and then the displacement to the downside, I expect this high to stay intact for the rest of the day. So if we carry on printing, so by the looks of it, price tapped back into the 1 hour order block, displaced lower again. So I expect this high to stay intact, and I expect this high to stay intact as well, because we got a move to the upside, then the displacement lower. This was the start of the New York session as well. But when it comes to New York session, when it comes to the different kill zones and times and sessions, that's going to be another topic for another video. So I expect this high to stay intact as well for the rest of the day. We carry on printing price, and then how many hours we got left, and that looks like it's the end of it. Sunday, so one more candle, and then yeah, that's the end of it. So as you can see here, we got the high that was formed, so price moved above the opening price, got a displacement lower to the downside, so we wanted this high to stay intact. Price moves higher, displaced again to the downside during the New York session, so this high, we wanted that to stay intact, and then we get our directional moves to the downside. So price moves higher, could get a sell position there, put our stop losses above here, can get another sell position, price moves higher, another sell position here, could put our stop loss above this high or this high, and then we get a move lower to close out the day. So then the low of the day was formed. The low of the day was formed here, which was the low of the daily candle. and then price is closed here, and we've got the close of the daily candle here. Moving on to the next example, we've got a bullish example here. So, like I said before in the previous example, if you go on to my previous videos, I suggest you go watch that. On fair value gaps, we have a 1 hour fair value gap here. If we go back onto the 15-minute time frame, so every candlestick that's printed here represents 15 minutes. So we've got the midnight opening price here, which is on this candle, Eastern Standard Time. We've got the midnight opening price, MNOP. We get a move lower into the fair value gap. Price respects the midpoint of the fair value gap, which is called the consequent encroachment, and then we get a displacement higher. So the fact that price respected the fair value gap and then displaced higher, it broke market structure as well. We expect this low that was formed to be the low of the day. So we got the low that was formed here, which is the low of this daily candle. So this candle here represents the day. So we expect this low to stay intact. So we'd want to look for any buy positions. If price pulls back into here, we could enter a buy position. So we've got price moving higher, it's moving higher. We don't really get an entry point. So price is just respecting these fair value gaps. Got the fair value gap here. Price went into it, displaced higher. Went into it again here, and it displaced higher. So yeah, it's not really offering any entry points. If we carry on printing, yeah, price just kept going higher. It's possibly formed a high of the day here. Just keep printing, printing, and then yeah, you get a close. That's the last point of the day, which yeah, so that's the bullish directional candle to the upside. So we've got the open, low, high, close. Got the open, low formed in the fair value gap. Got the highest point of the day formed, and then we get the close here, which is closed out there. On to the next candlestick print that I look for in the market are reversal candlesticks. Reversal candlesticks look different. They look completely different from the directional candlesticks, and the reason being is that the wicks on the reversal candlesticks are much longer than the bodies. So if you could remember, on the directional candlestick, the wicks are shorter than the bodies, but here we have a long wick and it's shorter than the candlestick's body. So we have the open, low, high, close, and then here we have the open, high, low, close. So now in the next clip, I'm going to show you what it looks like on the lower time frames. Moving on to the examples now, and we're going to start off with a bearish reversal example. So as you can see on the right hand side, we have the daily candle. We have the daily reversal candle, sorry, and on the left hand side we have the lower time frame, which is the hourly time frame. So as you can see here, we have the opening price of the candlestick, and then we have the opening price here. So the reason why the reversal candle is formed is because, as you can see, price is going up here. It looks like it's going to form a directional candlestick, and then we just get a quick reversal to the downside. So price moves higher, forms the high of the day, which is the high of the candlestick, but then we get a quick reversal, get a quick snap to the downside, and then that's why this long wick is formed. So after that snap to the downside, we then form the low of the day, which is the low of the daily candlestick, and then we get a close. So the reason why that long wick is formed, I'm going to say it again, is because of that quick snap, that quick reversal to the downside, and then we'd get a possible move lower to carry on the move. And now on the flip side, we have the bullish reversal candlestick. So on the right hand side, we got the higher time frame candlestick, which is the daily time frame, and then on the left side we got the lower time frame candlesticks, which is the hourly time frame. So each candlestick represents 1 hour. So if we go to the midnight opening price on the lower time frames, and we watch this extended line here to the daily time frame opening price, on the lower time frame, price moves lower to the downside. At first glance, it looks like price is going to form the directional candlestick. However, we get that quick snap to the upside to form the high of the day. So we've got the high of the daily candlestick. That quick snap up is what forms, this huge wick to the upside. And then after the daily high is formed, we get a move back into the range for the final closure of the day, where we get this daily close. Moving on to the next part of the video, I'm going to show you an example of a bearish reversal candlestick print. So just a quick one. I'm going to start off from the daily. As you can see here, we have price moved higher, and then we got a huge sell-off or displacement to the downside, which formed a fair value gap, a daily fair value gap. I'm not going to really talk about what a fair value gap is on this video just because of time, but yeah, I've got a previous video or a lesson on what a fair value gap is and what it looks like, so yeah, go watch that to understand what it is. So yeah, as you can see here, we've got daily fair value gap. I would want price to move into this fair value gap and then move lower to the downside to target this candle's low and Tuesday's low as well. So now moving to the lower time frames now. So yeah, like I said, on the daily time frame, I would want to see price move into here and then move to the downside. So I'm gonna watch that print. Price has moved into the daily fair value gap, then it's moved lower, and then we have the final close at 11 o'clock, or it's going to be 12 midnight, and then that's our reversal. So price moved in to form, it moved into the daily fair value gap to form the high, and that's the high point of the candle, and then we got the close, got the low here, and then the close, which is relatively close to each other. So the aim now is to now trade the first candlestick print that I look for, which is the directional one. So now that we've got the reversal, now we want the direction, because we know what direction we're going in, which is bearish. So price is telling you that it's on its way to the target areas. That's when we'll trade the directional candlestick print. And then as you can see here, the directional print one, we've got the open, high, low, and then close, and that's the candle there. So that's the first candlestick print we're looking at. So yeah, that's it all coming together. So we've got the reversal, price opened, it looked like we was going higher, then we got the quick snap to the downside, which formed the reversal candlestick. Then we got the directional candlestick. So we've got to open, high, low, and then close. So in this range here, that's when we would look for sell setups on even lower time frames. So we get our entries. to the downside to target the Tuesday's low that we were targeting. And last but not the fuck. And last but not the least, we have the indecision candles. I look for indecision candles in a market, not to trade, but I look for it to avoid certain trading days as well. So we got the price is open here, price then moved lower, then it moved higher, and then we got the close, but the close was relatively close to the open. So price is basically at the midpoint of the range, and we don't know. The reason why it's indecisive is because we don't know if price wants to move higher to target the high or move lower to target the low, because it's currently at the midpoint. The same as a bearish scenario. We've got the open, price moves higher, then it moved lower, then we've got the close. But like I said before, that the close is close to the midpoint of the range. So yeah, we don't know if it wants to target the high or target the low, hence why it's called an indecisive candle or indecision candle. But it would make more sense if I show you on the lower time frames in the example in the next clip. And finally, getting to the end part of the video, I'm going to show you an indecision candle example. So on the right hand side we have the daily candle here, this ugly ass candle. So we have a long wick here, another long wick here, and then we got the opening price and then the closing price. And then on the left hand side we have the lower time frame candlesticks that form this whole daily candlestick. So on the left hand side, yeah, this is the 15-minute time frame, so each candle represents 15 minutes, and I'm going to show you why it created such an ugly daily candle. So we have the opening price here at midnight, so we've got a midnight opening price. So yeah, the price opened, we've got a move higher, and we've got a move lower, another move higher, then low, then high, and then low, and then high, and then low, and then high, and then we get the close. So in all, price is just very choppy. It's choppy, it's choppy, it's choppy. And then the most important factor of this is the fact that price closed very close to its opening price. That's why price was this choppy, and then it formed this ugly ass candle. So yeah, in all, when this candlestick forms in a market, you stay away. It's a huge red flag. You will never lose money sitting on your hands. So once this candlestick forms, just sit on your hands. Don't chase money. Trust me, you will end up on your ass, man.
You can lose a lot of money chasing a bitch.
Okay then.
But you'll never lose a bitch chasing your money.
Fuck you, baby.
And that's the word of the day.
Exactly what Unc said, man. You can lose a lot of money chasing a bitch. And this candlestick right here is a bitch, man. You'll lose a lot of money chasing it, so stay away, stay clear. And yeah, that's that for that example. In fact, no, that's that for the whole video. So yeah, with indecision candles, just stay away. You'd only really want to trade the directional candlestick and the reversal candlestick. Those are the best ones to look for. You'd only look for the indecision candlestick when like you're looking to stay out of a market. But yeah, that's that for this video. If you found it insightful, please, drop a like, drop a comment, subscribe, so I can continue to do more videos like this for you to learn from. So yeah, man, hope you all have a nice day, and yeah, trade safe. Yeah.